Good morning, everybody. My name's Wayne Basford, and I will be the host, the compere for this morning's session, and Susan Oldmeadow-Hall will do most of the presenting. We're just waiting for a few more joiners to start the webinar, so make one more minute and then we'll start properly. Okay, looks a good time to start. Slightly less than yesterday, which is a bit concerning since I was so depressing in my presentation in terms of the challenges of COVID. So before we start, for those of us in Australia, I'd like to acknowledge that we're sitting on the land of the traditional custodians and to pay respects to their elders, past, present, and emerging. So the way this session is going to run this morning, Susan Oldmeadow-Hall will continue with the COVID challenges, the COVID accounting issues, and then we'll also deal with some of the new accounting issues, being obviously IFRS 16, Interpretation 23, and some amendments to IFRS 3. So for those of us people that were on the call yesterday, we had two interesting poll results that we ran in yesterday's session. So when people originally answered the poll in terms of whether there were going to be significant impacts on financial reporting, we actually only had 18% of respondents saying they thought there were going to be significant financial reporting challenges. So, but when we looked at the business issues, 50% of respondents said they were going to have COVID was going to have significant issues on their business. So following on from that, we'll start the session with the first poll, looking at which do you think will be the most significant accounting challenges. And for clarity, you are allowed to tick more than one of these. And then for all the very, very sharp-eyed auditors that are on the webinar, it will most likely add up to more than 100%. So be a good feel to see whether people have got going concern issues. Noting that when we ran on this on the natural resources slide, we actually had 39% of those that attended that webinar saying they thought they were going to have going concern reporting issues, but it'd be good to see whether that applies to this audience. They're a nice voting response, and unfortunately for most people on the call, it looks as this is going to be quite a depressing reporting season, or challenging reporting season, if I'm supposed to be positive. That's great. I'll give people another 30 seconds to vote. We've got a very good voting rate at the moment. 75% of people have voted, 76. So I'll just keep a few more seconds. Okay, if people would like to digest the challenges that we're going to see, and following on from the 39% in the natural resources, and following on from the 50% business impact result that we got from yesterday, I think the 59% is not that surprising, but it is horribly putting in the challenges that we're living in into context. 59% of people on this call thinking they're going to have going concern issues. 69% on impairment of assets. So when I was talking yesterday, the challenges of determining recoverable amount, the challenges of determining VIU. And as an interesting concept, 24% are going to be renegotiating debt. So people that are out there are geared, and for those people in the financial services sector, again, these are interesting, challenging times. So with Susan, your comments on this, and over to you.
Well, I guess the comments are, it's not really surprising. This is consistent with what we've been talking to people about and understanding where things are at. So unfortunately, if you have business impacts, it's very likely that you're going to have disclosure impacts. And so I think the results are consistent with what I would expect, given when we did the business impact poll yesterday, we had 50% of people saying they were going to be significantly affected and 47% saying there was minor impact. So getting the disclosure right in your financial statements is going to be quite critical this period. And that's why we're going to kick off with the disclosure issues in relation to COVID. And I think it is really important to make sure that we get this correct in this reporting season. So I did get a question from one of our clients saying, do we actually have to forecast how we're getting out of COVID when even the government can't make any predictions? And unfortunately, the answer to that is yes. And how you do it is by making sure that you give very transparent disclosure. You know, that's just so critical in this period. Nobody, not even ASIC, is going to expect that you're going to have a crystal ball and be able to predict this correctly. So that's not what's required and not expected. But what is expected is that people can understand what you've done, what assumptions you've made regarding how this potential crisis can impact you, and giving the sensitivity disclosures around how those potential impacts are going to impact you. Particularly, you know, so many people said impairment of assets was going to be an issue for this period, and going concern. So really providing the guidance around what your assumptions were in relation to those is just critical then for people to say, well, you know, the impact wasn't as bad as that. So therefore they did this impairment write down that wasn't as bad as what they predicted, or conversely, it may be different. But as long as the market is informed about what you've done, how you've done it, what assumptions you've made, you're holding yourself in a much better stead than other entities who haven't got that transparency occurring. So today we're going to really look at some of the financial reporting standards that you may not have thought about for a while. And you know, normally when we do these accounting updates, we would just talk about, you know, let's talk about what's new and what you need to update your accounts for. But because we're in this pandemic, we really need to start thinking about not so much what is the new accounting standards, although that is important, and I will talk about AASB 16 later in the presentation, but really looking at what are the requirements that you need to make in this current reporting period. And you need to update your accounts not for just what's new, which is what normally happens. People sort of roll forward last year's template and then just adjust for the new disclosures. This year, what we really think you need to do is revisit your accounts and make sure that the disclosures that you had in the prior year continue to be relevant. And so that's why I'm going to focus on these particular standards that are likely to need new disclosures in the current reporting season. And given the poll results of so many people saying that there was going to be a going concern issue, AASB 101, paragraphs 25 and 26 deal with going concern. And it requires the disclosure of significant uncertainties as to whether the entity will continue as a going concern. And yesterday, Wayne ran through, you know, his analysis of, you know, the three possible scenarios, you know, saying, well, we've done an analysis and we consider we continue to be a going concern. But if there was significant judgment about that, you disclose the significant judgments. The other option is we've done the analysis and we think there's significant uncertainty that will continue as a going concern. And this is where normally you'll have the emphasis of matter in your audit report as well. So that is the other scenario. The third scenario is we've done the analysis and we don't think we are a going concern. So you've got those three scenarios and they all have different disclosure requirements around them. The other paragraphs to really note is paragraph 122, 125 of AASB 101, and that requires disclosure of significant judgments and estimates. So major sources of estimation uncertainty at the end of the reporting period that have a significant risk of material adjustment. They're the things that you should be considering about disclosing. And normally we find these areas in relation to the carrying value of non-current assets. Definitely, if you've got goodwill on your balance sheet, the carrying value of goodwill, you know, your tax balances. So where you're having to make assumptions about carrying values, and even things like trade receivables, you know, now how good will the collectability be? You know, so certain items that previously you might have felt very confident about, currently in this environment, no, it's not so much. So you really need to consider these things. And you need to disclose the change in accounting estimates that you've had from previous reporting periods. And if the amount of the effect in a future period is not disclosed because estimating is impractical, you need to disclose that fact. And so, you know, that's going to be one of the areas that we do have, is that people have done estimations, but providing the sensitivity analysis, sometimes you may not be able to really provide that to such a degree that you would like to. And so then even providing disclosure of that is important. So really, judgment is essential based on the latest available reliable information, and those judgments need to be disclosed. And I think for anyone who's a listed company, this is where you really want to get your board and audit committee across. Get them comfortable with the key judgments that have been made, because at the end of the day, it is the directors that are responsible for the financial statements. Paragraph 134 of AASB 136, impairment of assets. Now, this is a standard that really is quite complicated. AASB 136, it has very specific requirements, and it is the one standard that ASIC have been causing many entities to have restatements in relation to. When we look at, you know, ASIC's media releases where there's been restatements, usually it is around this particular standard. And you know, if you have an ASIC letter come to you, you need to take it very, very seriously, because actually answering those questions in an appropriate way is so important to avoid having a real full-on ASIC investigation occurring to you. And the best way of preparing yourself for that is to actually create the documentation at the end of the financial year, because that's really what you're expected to do. So we're going to have a look at what are the disclosures when there's unamortized intangibles. So things like unamortized trade names or goodwill. You look at the carrying amount of the goodwill allocated to the cash generating unit, carrying value of assets with indefinite useful lives, the basis of the recoverable amount test, so either value in use or fair value less costs of disposals. And then you have key disclosures in relation to either model that you've used. So with impairment of assets, when you're looking at determining the fair value of them, you may want to consider a number of scenarios and assign probabilities to those scenarios. So in this environment, you'll say, what if we are able to continue our operations? What if we have to do a shutdown of our operations? And I know with BDO here, we've had our office closed down for a couple of weeks and people have been working from home. So what has been the impact of that, and how long do we expect that to occur? do we assume that there may be another second wave and we'll have to go out of our offices again and work from home? And what impact would that have on us? You know, and I work in the audit division, so what impact would that have on us trying to do our audits remotely rather than being able to go out to our clients? And the other part of it is, what if you don't have another scenario? Maybe what if the workforce is not available due to sickness? So considering and assigning probabilities to the different scenarios is actually probably the best way of dealing with this pandemic and looking at impairment. That's easier to do, or probably a more comprehensive way of doing it, than adjusting your discount rate. So the standard does allow you to take into account variability of cash flows either by different scenarios or through a discount rate, but really trying to work out an appropriate discount rate to deal with the different probabilities and the likelihood of those would be very difficult. So the common view in the market is that you would do scenario analysis, and then you would just make disclosure about the scenarios that you've applied. So these are the things you need to consider about in relation to disclosures. And this is really the sensitivity analysis disclosure. And disclosure of your assumptions, the probabilities you've assigned, is really key in this reporting area. AASB 7, your financial instrument disclosures. So I know people put a lot of work into this disclosures when the standard was issued. Now is a time to really revisit it, because you need to disclose the nature and extent of risks associated with your financial instruments. And based upon the responses that we had to the polling question, many people think they're going to have to renegotiate their debt. So that definitely is giving rise to changes in the nature and extent of risk. And also you need to consider, you know, your classification, you know, of between current and non-current. But this one here is about examine the risks you're exposed to and ensure you update your disclosures and communicate the risk exposures and their sensitivities. So credit, liquidity, and market risk disclosures. So if you have loans receivable, trade receivables, you need to disclose the credit risk arising from those assets. Disclosure of liquidity risk may need to be expanded. And so in this particular period, where, you know, we've been doing analysis on companies, their quarterly statements, and looking at the cash balances reported, you know, we know in the mining sector that cash balances have decreased in this last quarter. So that really does show that there may be liquidity risks out there in the marketplace. And of course, this is really the big one. If you have defaults and breaches, you need to disclose those, and you need to provide details surrounding the details of default. Where you've had a renegotiation from a loan modification, so if you've renegotiated your debt, you need to consider whether it's given rise to a significant modification which requires remeasurement and therefore recognition of gains or losses from derecognition or modification. And also consider, have you got cash flow hedge items for which now, given the current market conditions, you don't expect you'll be able to deliver into those cash flow hedges. You're not getting those, you're not buying those materials that you thought you were going to buy and you've had a cash flow hedge for. You know, then you need to fair value those and discontinue your cash flow hedge accounting. So these are the things that you need to consider in relation to this COVID. So really, when we're looking at impairment of assets, so many people just think, oh, we're just in AASB 136, the non-current assets. But really, you've got to think far more broadly. You know, have you got exploration and evaluation? Then you're in AASB 6. You know, have you got inventory? Look at the impairment rules and disclosures in AASB 102. in relation to tax, AASB 112, investments in associates and joint ventures, AASB 128, and AASB 136. So we've got a much broader scoping and area that we need to look at in relation to impairment. So before I move on, I just wonder, have there been any questions in relation to impairment?
I had one question in terms of what do you do with impaired PP&E? And obviously, as I said yesterday, it gets caught in IS 36. Is that item of PP&E not producing as well as you thought it would? And if it's not selling, you're not making fees, well, that PP&E is not generating the cash. It's potentially going to be part of a CGU. So it may be impaired as a standalone item, as a building, as an idle piece of kit, or it might be within an overall CGU. But you need to do the impairment. You know, you've got the impairment triggers under AASB 136, and it's going to be very difficult because if you've got buildings that you normally sanity check their fair value, so clearly it's worth this, and you get a skilled valuer to say the value of it. As I said yesterday, I really, valuers, how do you value major pieces of equipment or major buildings in a market that's in so much turmoil and confusion? So
well, I think you answered your question, Wayne. And finally, in relation to not impairment of assets, but looking at AASB 137 provisions and onerous contracts. And given the change in economic conditions, there's much more risk that people have now got onerous contracts. And one of the examples that we had here at BDO is that we had a conference that we were going to hold, and we had to cancel it due to the COVID breakdown. And so therefore, the cost of the conference would have been recognised as a liability at the time of cancellation because it was an onerous contract. And then you have to separately look at insurance recoveries. And recoveries, you can only recognise the receivable if recovery is virtually certain. And often with these sort of insurance contracts, you have to be pretty careful because, I think the insurers, particularly at this time, are sort of looking at ways to get out of having to pay these fees, so these recoveries. So you may result in the recoveries being recognised in a later period than the cost or the losses suffered. So that is a very real-time example that many businesses are facing in relation to paying in advance for conferences or having contracts that now have become onerous, that they're not able to use, and they're going to give rise to an economic loss. I'm going to move on now to general financial statement presentation, measurement and disclosure. So we're looking at AASB 101. And this is such a fundamental one. And I really hope that people are not going to, really take a step back and think about what are the key risks here. And one of the key risks when preparing financial statements is making sure that you get your liabilities classified correctly between current and non-current. In the last financial crisis, we had the Centro case come out of that, and there Justin Middleton talked about it being a blind Freddy error that they classified their debt as non-current when they were in breach of the loan conditions, so therefore it should have been classified as current. You can only classify your financial liabilities or any liability where you have an unconditional right to defer the settlement for at least 12 months. So really make sure that there's no blind Freddy errors in your accounts. The other area to be aware of, now the aim of AASB 5 is to restrict which assets can be classified as held for sale and which operations can be shown as discontinuing. And the reason is because there really is an incentive to classify loss-making businesses as discontinued. But you can only classify an asset as held for sale when it's available for sale immediate sale in its present condition, and the sale must be highly probable within 12 months. And we have underlined that here. And the reason for that is this highly probable within 12 months is going to be quite a high test to meet in this current environment. You know, I think you'd almost want to say, unless you've got a signed agreement, you wouldn't want to be classifying things because, or unless you really think it's in such a demand that you'll be able to realize this asset. So that's going to be a hard one for companies in this reporting period. The other thing to note is if you're abandoning a business segment or a unit, that is not, you can't classify that as a asset held for sale. It's not. It's been abandoned, so therefore it's not permitted to be classified as held for sale. But the other side of it is if you think you've got liquidity issues, you may find that more assets may be classified as non-current assets held for sale if it really requires you to liquidate certain assets to maintain a level of solvency. So that's also another part of really looking at how are you classifying your assets and treating them. Now, moving on, we're going to move on to revenue, and everyone loves revenue because, you know, that's money coming in. But AASB 15 revenue is a standard that I know Wayne has a particular passion about. So I'm going to hand over to Wayne for this one.
Thanks, Susan. Recognizing I was the miserable person yesterday, so I now get another miserable session. As Susan correctly says, I am extremely interested in AASB 15. Observations, we transitioned last year onto 15, and observations are a lot of Australian entities did not correctly apply AASB 15, and this will really show how the standard works. And you've got to consider what is variable consideration. Everybody last year should have been thinking about what are the discounts, what are the rebates, what are the price concessions, and you shouldn't be reducing your revenue when you issue the credit note. You should have just built in what is the expected credit note that you're going to issue. There's nothing wrong with the goods and services, no problem, but your major customer phones you up and said, times are tough, I want a price discount. So that has to be, and you read in the press, the major retailers refusing to pay rent to the landlords. It's going to be, in this world we live in, there's going to be major clients, major customers that will be contacting, horribly I'll say, each one of us and saying that, can you give me a discount? Can you help me out? And if you've done that, that needs to be caught into AASB 15. And if we just move to the next slide, one of the key areas of applying AASB 15 is, of course, the constraint. You can only recognize revenue if it is highly probable that that revenue will not reverse. So if you are doing a major construction contract, etc., if you've got a major supply contract, in today's times, you're late on site, you can't get access on site, you can't get your staff, you can't get spare parts. But it is very challenging. And if you end up recognizing revenue in your June 30th financials, and then it ends up being reversed in your December 2020 financials because something happened, that clearly will show that you didn't apply the requirements of 15. When we look at revenue recognition, you can only recognize revenue if it is probable you'll receive cash. So some people on this call will have a great history of billing monthly for a retainer, billing monthly for access to IT, to access to certain technology, now you actually start to see bad debts blowing out, your debtor aging is blowing out. That actually is not automatically an IFRS 9 issue. It is more likely to be a 15 issue. If your customer is in financial distress, very likely you should not be able to recognize that revenue in the first place. And emphasizing for any people on this call in construction contracts, are you going to incur liquidated damages? Is it highly probable you will not incur liquidated damages? Because it's not highly probable, then you build it into your forecast, your percentage of completion. So revenue is going to be, I think, a very challenging financial reporting topic. So back over to you, Susan.
Okay. You did scare us all, I think. So let's look at fair value measurement. And this is really hard in this particular period, because fair value is defined in AASB 13 as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. And when we look at orderly transaction, it's not a liquidation base, but it's really hard in this particular environment where we've got highly volatile markets and potentially a lack of an active market existing. So current market conditions may appear to be a distress sale, but if those conditions exist broadly in the market, then they need to be taken into account in determining your fair value. And really what you're doing here is disclosure is probably key around what assumptions you've made if you're not in a specific model where you haven't got the level 1 quoted on an active market price. Where you are in level 1 prices, you must make sure that you're using the price as at the balance sheet date. Even if the price has improved subsequent to year end, it is as at that date. And I know when we look at ASIC reviews, that is one of the key areas that they look at, particularly in their when they're looking at impairment models, is that you're using market consensus prices and forward prices that existed as at the balance sheet date. So please make sure that you're using the correct pricing model. And then AASB 13 requires disclosure about valuation techniques, inputs and assumptions used, as well as sensitivity analysis. And the amount of disclosure varies with the level of the fair value hierarchy. So where you have level 1 fair values, which are quoted on an active market, you have less disclosure around those than level 3, where you're actually having to provide your own values. And fair value measurements that are in level 2 that shift to level 3 due to an increase in unobservable inputs require additional disclosure in the current period. And I imagine that that could well be the case in this reporting season. Other reporting issues. So in relation to leases, we've had to recognise leases on our balance sheet date as at 1 July 2019, and now we've got the awful situation that there's the potential that that right of use asset may be impaired. But you do need to look at it, and you need to look at have the current market conditions mean that some of the lessee options that you assessed on transition have now changed and require remeasurements. And you need to look for, if you're a lessor, is there impairment of the lease receivables? So we have issues around accounting for lease modifications where you're getting concessions by landlords to tenants when operations are interrupted. And I know that's been a massive issue here in Australia. And normally where there's been a concession, it gives rise to a lease modification, and lease modifications require a remeasurement of your leasing obligations. However, the International Standards Board has issued guidance, so an amendment to IFRS 16 to provide lessees with an optional short-term exemption from assessing whether a specific COVID-related rent concession is treated as a lease modification. And that is really a very narrow scope amendment, and it is optional, but it does allow those rent concessions to be treated as not a lease modification, so you don't have to remeasure your lease liabilities if those options continue up to a period of 30 June 2021. So that has been just issued by the International Standards Board earlier this month. Otherwise, if you don't fall within that, you do need to do a remeasurement of your lease. The other thing to look at is if you're getting incentives provided by the government, is it a modification to your lease or are they government grants in the scope of AASB 120? So this is really an area that I would imagine most people are probably impacted and will need to consider at 30 June this year. Termination benefits provided to employees. You need to look at the timing of your termination benefits and when you've advised the relevant employees. If you've just done an announcement that we're going to do some restructuring, that doesn't give rise to a present obligation to pay benefits, and so therefore no provision would be recognised. It's typically when the offer has been communicated to affected employees and it's been communicated with such detail that you're unable to withdraw the offer, that's when there is a present obligation and the termination payment will get recognised. We often find in these times, a lot of companies may take the view, well, we're going to have losses, the market's not expecting anything great anyway, let's just try and provide for as much as we possibly can. And so sometimes you will find that companies are actually overzealous in trying to recognise losses. You can't recognise losses for future operating losses, and you can't recognise provisions for those. So be very careful about what you recognise and when you recognise it. Obviously, if you have communicated to employees that they're going to be terminated, then yes, you provide for it because the offer has been put out there. The other area that is a common area that we're seeing of modifications to and changes to the current accounting is in relation to share-based payments. And AASB 2 is a standard that works that share-based payments get measured at grant date and then they get expensed over the vesting period. So unfortunately, even if your employees' option plan that they're participants of, currently with the current market conditions, those options are worthless, that doesn't change the expense that needs to be recognised. And if you were to just cancel that plan, then that would give rise to immediate vesting of the entire balance. So you may want to issue new performance shares or modify your share-based payments, but be very aware that it's likely to give rise to potentially adverse consequences from an accounting sense. That doesn't mean it doesn't make good business sense to actually pay people in shares to maintain your liquidity, but just be aware of it from an accounting perspective. And for those of you who are December year ends, you may think you're let off lightly because you're very lucky to get in with your December reporting before all of this happened, but you will need to consider how do you need to beef up your half-year accounts. And the reason for that is interim reports normally are quite short because they refer to positions and performance of the last reporting period. But if there's been significant changes in the operation since the last reporting period, then you do need to disclose those. So I'm going to have a little talk through some of the requirements for the half-year accounts. So many aspects of financial reporting can be significantly affected by coronavirus. And so when you're looking at it, some of the things you will need to consider in relation to the write-down of inventories to net realisable value, recognition of impairment of financial assets, changes in business or economic circumstances that affect the fair values of financial assets and financial liabilities, any loan defaults or breaches of loan agreements, and transfers between the fair value hierarchy. So when we did our poll at the beginning of today, we sort of asked questions around going concern, impairment, and renegotiation of debt. All of those things need to be captured in your half-year accounts. So if you have indicators of impairment that exist for a CGU that contains goodwill, the goodwill needs to be tested for impairment in that interim period, even if it doesn't align with the annual testing cycle for goodwill impairment testing. And really, if you have any impairment indicators, you need to then look at running a impairment test, a AASB 136 impairment model. And so I think for most companies, you really will need to consider asset impairment at the half year. And one very, very important standard is AASB 110, events after the reporting period. And as the outbreak situation changes and evolves quickly, you really do need to consider what has occurred after the reporting date that gives information about circumstances that existed at the reporting date. So if we're in the situation that at the reporting date, the virus has really slowed down and things weren't so bad, then perhaps that impairment model that had you with a likelihood of having to shut down operations for a number of months is no longer appropriate. And so this is where using hindsight can help give you better information about the conditions that existed at the reporting date. But conversely, events may require you to actually make an assessment in a different way. So really understanding subsequent events and how they impact your understanding of what conditions existed at the reporting date is going to be very, very important. And announcements or implementation of new measures to contain or slow down the virus, such as requiring people to work from home, really may now be more likely to be adjusting events. So Wayne, have we had any questions on that before I move on to the regulatory update?
So the key, very good question, certainly after you'd gone through the disclosures, was has BDO issued any illustrative financial statements to go through this disclosures? And my response to that question was no, we haven't, and it is extremely unlikely that we can do it, that everybody's facts and circumstances will need to be tailored. I had a call yesterday from a client, an on-audit client, requesting that we help them check their financials and double check they complied with 101, 108, 136. And that's going to be a required service because, Susan, you've correctly said the biggest way directors can protect themselves and to properly communicate with their shareholders, their stakeholders, is proper disclosure and truthful disclosure. There was ASIC came out with further guidance yesterday, and I was reading action on class actions and whether there's any protection from class actions. And if directors are overly bullish or are not disclosing information that they're aware of, they're exposed to risk. So that was the only question.
Well, that is a good segue into our regulatory and filing obligations. And the good news is that around the world, public statements have been made by regulators saying they want full and frank disclosure of the impact of an outbreak, but also providing some reliefs. about deadlines and which financial statements and other regulatory filings are required to be submitted that have encountered significant barriers in doing so. And here in Australia, we had a media release and that allowed the extension of AGMs and also AGMs to be held electronically, which really helps with making sure that you comply with the law around having an AGM, but also comply with the laws around public gatherings that we have here in Australia. And in relation to filing deadlines, there was ASIC media release on the 13th of May for 30 June 2020 reporters, allowing them to have a 1-month extension. Now, this is really interesting because the longer you extend, then the longer the period is which you have to assess going concern, because going concern needs to be 12 months from the date of signing of the financial report. So if you do have going concern issues, you may actually think it's better to get your financial statements out as quickly as possible. Alternatively, you know, this extension will give you probably more information about the conditions that existed as at the reporting date. So it will be very interesting. We've got a poll now, and I will take it to Wayne. You know, when do you think you're going to file your 30 June financial statements? And Wayne, with this poll, once you've closed it, can you show if there is a way that you're able to show the polling results actually on the screen, which would be useful?
I believe all I have to do is launch.
Yes, you launch the poll.
Because we've only got 30. This one would have been an obvious one. I'd imagine previously most people, the majority of people would have pressed September, knowing a lot of people are on this call. And myself, yourself would have happily gone on holiday and gone on conferences in October. And as a heads up, Susan, it's not looking that way this year.
Oh dear, I had holidays booked for October.
At least they've been cancelled. So I'll give it another 30 seconds to see when people are planning their workload, whether they're going to heed, people are going to heed your advice, Susan, and get the pain out of the way quickly, or whether they're going to be optimistic and believe we'll have much better line of sight by the time that October comes. So I'll close the poll in another 10 seconds. So Susan, we're not going on an October holiday.
Oh dear, I suspected as much though.
And all of this is going to be very interesting for even looking at capital raises. When do people need to raise capital? Does this fit in with those shareholder timetables, etc.? But it is very interesting that so many people are expecting an October filing date rather than September. Okay, Susan.
So we'll move on, and I do love this screen. Yesterday, Wayne commented that some of our pictures didn't really look very COVID, but I think this is typical of working from home in the COVID environment. Wayne and I haven't shown our faces on this presentation, but that doesn't mean that I'm sitting on the floor at home on the carpet.
It does potentially mean I've got the same hairstyle as that guy.
No, in your dreams you have that hairstyle, Wayne. AASB 16 leases. This is the new standard that we've had, and look, we've really covered this previously in a lot of detail, so I'm just going to highlight really what some of the key disclosures will be. If you haven't really got to grips with AASB 16, fortunately on BDO's website we have a lot of webinars which deal with this particular standard, and the IFRS leader, Aletta, has done some great presentations in relation to this. But the main point to note is, in terms of your accounts, you're going to be recognising those assets that were previously operating leases on your balance sheet. And the sort of assets and service agreements you need to look at in potentially recognise are items of infrastructure and large items such as delivery vans, power stations, manufacturing equipment, plant and equipment, things like your photocopiers, office furnishings, petitions, and building fit outs, office premises, retail, storage facilities, warehouses. So these things are likely to come onto balance sheet when previously, they were just considered to be operating leases. And on your balance sheet, you need to do disclosures of additions to the right of use assets, year-end carrying amounts, your lease liabilities, and maturity analysis for lease liabilities. And in profit and loss, disclosing depreciation, interest. So you will have rental expense to the extent that you have variable lease payments not included in lease liabilities. So those have to be separately disclosed. And if you've taken advantage of the low value lease recognition exemption, then you have to disclose separately the expense that you had in relation to that low value lease recognition exemption, and any gains or losses from sales and leasebacks. So these are the key disclosures that you have in relation to the leasing standard. And then you have the narrative disclosures. So you need to disclose your nature of your leasing activities, what are your short-term lease commitments, description of liquidity risk related to lease liabilities and how that's managed, and qualitative disclosure of the use of exemptions for short-term or low-value lease items, and restrictions or covenants imposed by leases. And look, your disclosure around loan restrictions and covenants is going to be really important in this year. You don't want to get those wrong, particularly when people are looking at, what are the conditions imposed on this company. And transition. Hopefully you've already dealt with transition to AASB 16. If this is a standard that you've really left and you haven't done anything too much on it, we are running a number of leasing masterclasses, so maybe you need to enrol in one of those if you haven't got to grips with AASB 16 when we're so close to the financial reporting year end. Another new requirement that has come through is Interpretation 23, uncertainty over income tax treatments. And AASB or Interpretation 23 is a measurement interpretation, and it really clarifies that you need to measure your tax obligations on the basis of what would be the position that would be taken by a tax authority if they had perfect knowledge of all of your facts and circumstances. And I like this next disclosure, this next slide, which talks about when you apply it. So Interpretation 23 does not apply when it's probable a position will be accepted. So if you and the tax authority are in the same agreement, you don't have to worry about Interpretation 23. It applies when there's uncertainty whether you will be allowed this tax treatment if you'd had a tax audit, for example. So if it's probable, you use those assumptions in computing current and deferred tax. If it's not probable, uncertainty is a component of measurement. And we're going to run through a very quick example to explain how you use that uncertainty. The really difficult bit, and the bit that our tax practitioners have said to us, well, I don't know how people are going to do this, is coming up with the probabilities and with, what the position the tax office would take and how to accept that. But that is really not a question that I can answer. And I do like our examples because we always just have the facts of what the percentages will be. We have entity A has two subsidiaries. B and C operate in different tax jurisdiction. B produces more raw materials and sells them to third parties as well as to C. Now, when B sells to third parties, it sells at a higher price than what it charges to C, who gets 20% less, pays a 20% less price. Now, the audit team has consulted with the tax expert who believes it's not probable the position would be accepted by tax authorities. Only a 25% chance it would be accepted. And if it wasn't accepted, it would result in $1 million tax assessment to entity C based on transfer pricing rules. Based on recent activity and tax enforcement priorities announced by the government, the tax expert considers that there's only a 5% chance that they will be subject to a tax audit before the examination period expires, which will be in 5 years' time. So the question is our liability $1 million by 75% uncertainty by the probability of detection, which is 37,500, probably not material, or is it 750,000? And the answer is Interpretation 23 says you don't take into account detection risk. So there should be a provision for tax, a current tax expense, and a current tax liability of 750,000 recognised, which is likely to not be immaterial. So if they didn't have a tax audit over the 5-year expiration period, what happens? Well, that current tax liability just sits there until the expiration period, and then you de-recognise that obligation on expiration. So that is quite maybe different to what people are currently doing. This is very much consistent with what is happening in US GAAP. So Interpretation 23 doesn't introduce any new disclosure requirements, but it does refer to AASB 101, significant judgments, and also the assumptions and estimates made. And so if a conclusion is that it is probable that a tax authority will accept an uncertain tax treatment, consider disclosing the potential effect if they were to not accept that position. So that's a very important one for people who have tax areas and positions that they think if they were to be tax audited, this is something that they would need to work on. Then really focus on this before we get to the financial year end, because this is what you're required to book in your financial statements. And the final thing is, if you have a business combination, you may want to early adopt AASB 3. And that is, the amendment has been made post an implementation review of AASB 3. And the key changes is updating the definition of a business and adding an optional concentration test. And this is really useful, particularly for businesses that are acquiring something like a shopping centre, where it may be considered to be a business because there are people and processes and lease agreements. However, predominantly the value is around the actual asset that you've acquired. And in that case, you may find that you fall within the optional concentration test. And the reason why you may want to have it classified as an asset acquisition versus a business combination is, with asset acquisitions, you don't recognise goodwill. With asset acquisitions, transaction costs get capitalised rather than expensed. Asset acquisitions, you don't have to recognise deferred taxes if there's a mismatch between the carrying base of the asset and the deductible cost base. So the recognition of non-controlling interests is different too on asset acquisitions. And with business combinations, you have to fair value the assets and liabilities acquired. Asset acquisitions is at the purchase price paid. And the accounting treatment for contingent consideration and consideration paid in the form of equity instruments also differs between business combinations and asset acquisitions. So considering this amendment to the standard and the narrowing of the definition of a business may be advantageous to you and definitely worth considering in the lens of all of these requirements. So this just tells you what amendments have been made to the standard and the optional asset concentration test, which says you have an asset acquisition if substantially all of the fair value of the gross assets acquired concentrated in a single identifiable asset or group of similar assets. And, you know, we will find this in the mining sector when people are buying a mine, or we find it with property. So these are the areas, the industries that are likely to be able to meet that concentration test. And now we've hit the end of the presentation. So thank you everyone for bearing with us and staying with us through this presentation. Wayne, do we have questions?
We have one question, because I think you've just added salt into the wounds of disclosure. Very valid question. You know, your suggested question, your disclosure on interpretation 23. The question is, isn't putting details of tax treatment uncertainties waving a red flag and creating issues for transfer pricing?
I think the answer to that has to obviously be yes. And, you know, that this is a measurement requirement, interpretation 23, but the results that we had, because that was coming out of the US and because they've been doing this for a while, is the tax authority in the US became very good at analysing financial statements and trying to understand what was in current tax liabilities. And so, yes, you know, this is a requirement, and it may be a requirement that requires you to disclose things that you potentially don't want to disclose, but, you know, the rules are there.
Thanks, Susan. And noting we're nearly at the end, and I hope these two sessions, originally pre-COVID 2 months ago, we were planning on a 3-hour session delivering face-to-face, dealing with the challenges of applying AASB 16, dealing with the challenges of interpretation 23, and looking at issues that companies had with ASIC. So those issues in terms of the complexities of applying AASB 16 are still there. I know a number of people on this call filed half-year accounts, so they've adopted. I know there's other people out there that are not listed, so you've still got the challenge of 16. We are running IFRS 16 masterclasses if people want to enroll in those and to look at how you can calculate these lease liabilities. And equally, with all the issues we've dealt with, we are running COVID masterclasses. Having run the 2 presentations this week and last week, I may be rewriting some of that material or considering possibly sectionizing it. But we are there trying to work out to support the people on this call. So yesterday I started the presentation. Susan started the presentation with a poll, and I think it's timely that we rerun that poll. So do you anticipate that the preparation of your 2020 financial report will be more complicated because of COVID? So if people can look at this and try and cheer me up and see whether this is going to be an easy reporting season or a difficult reporting season. Noting that when we ran this poll yesterday, 18%, only 18% of people said they thought it was going to impact them significantly. Okay, I'll give people another 10 seconds to decide where they are and whether those people are too hopeful to be too early to say, possibly because they intend filing on the 31st of October. So, okay, I'll close it now. And over to you, Susan. What do you think?
Well, it's not surprising to see that the numbers have grown in relation to the significantly and the minor. And it's heartening to see that people have moved out of the too early to say bucket as well. But definitely, you know, COVID is the challenge really for this reporting season. Unfortunately, we're on uncertain economic times, and that's reflected in these results. Do you have anything, Wayne, to say in relation to this?
I'm not on the poll itself, but all I'll end with saying is I wish everybody the best of luck. Stay safe and look forward to the queries. But thank you.
Yeah, thank you for attending the presentation. And we look forward to catching up with you either virtually or in person in the future.